Hey everyone, this is Greg Laurie of A New Beginning, heard daily on Bible School Radio 91.3 KDKR Decatur, Dallas, Fort Worth, and on 91.3 KYJC Commerce.
Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, how is the consumer holding up? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, TransUnion is a global power when it comes to consumer information and trends. They hold actual data. This isn't about surveys. It's actual data on everyone being one of the big three credit reporting agencies. Charlie Weiss, as Senior Vice President and Head of Global Research for TransUnion, is here to give us a look at today's consumer and what's happening there. Charlie, always good to have you on the program.
Great to be back with you again.
So before we dive into the info concerning the consumer pulse, I want to get your take on inflation and how the consumer is holding up. You know, we have what I call stagnant inflation that doesn't seem to want to go higher, or certainly doesn't want to seem to go lower. Obviously, however, you labor with the consumer has been able to hold on. The question is, how much longer can they hold on in this environment, and what is your take on the general effect of inflation on consumers?
So it's a really interesting question because there's a lot of different perceptions on what inflation actually is. So if you look at it at its pure definition, inflation is the rate of change of prices. And higher inflation means prices are increasing at a higher rate. Now, break that down from what consumers are feeling. We've had huge improvements in terms of the rate of inflation over the last couple of years. I think it peaked at about 9.1% in 2022, and now we're down in the 3.5, 3.6% range. That's a big improvement. But consumers don't feel that improvement. Why? Because prices are still going up. I mean, in most cases, prices are going up just about all the time, but they're being layered on top of these higher prices that we saw jump enormously over the past couple of years. So when consumers hear inflation coming down, they, in many cases, think, well, that means prices are coming down. That means I'm going to be paying less for gas and for groceries and for dining out and for rent. Guess what? That's not going to happen. The actual prices are not going to come down outside of things like gas. I mean, gas is always going up, going down, right? You never know what you're going to get at the pump. It's like a roll of a dice. But for most things, like rent only goes in one direction. It goes up. And so that's what consumers are dealing with, is the fact that prices are higher. It feels like, well, that's inflation. No, that's the fact that prices are higher. And so that's what consumers are struggling with is 2 years ago, I could take my family out to dinner for $50. Now it costs me $70. I can't afford that. My wages aren't keeping up with that. And in some cases they're right, but in many cases the wages actually are keeping up. It's just that consumers don't feel that way because they're anchored on what they were paying before for those things, gas, groceries, rent, etc.
That's interesting because, you look at what obviously consumers were paying before all the prices started going up. I mean, if you look a couple of years into the future, I mean, are we settling into, instead of inflated prices, into what's normal? Or do we stand...
Exactly.
Yeah, that's...
Yeah, no.
Yeah.
I know exactly what where you're going with this. Yeah, there's a new normal, and it's just that, prices have been rising pretty steadily at the 2 to 3% range for so long. We've gotten used to that, and it's one of those sort of gradual things. It's like getting into a whole a tub and having the water slowly warm up on you versus jumping into a hot tub and man, you get burned right away. There was such an increase in prices that we saw in 2022, 2023, that consumers are not used to that new levels. But the reality is that if you were paying $8 for lunch before, but before, now you're paying $12.
Sure.
Guess what? You're going to be paying $12 for the foreseeable future, unless you either start bringing your food to work or find a cheaper place to eat. That's what it's going to cost you now, and it's just that it's going to take a while for that new normal to really settle in.
It's interesting because that is not what you hear in the media. That's not what you hear coming out of Washington. But that is the truth and the reality of what's happening. It's as ridiculous as saying that Chick-fil-A is going to all of a sudden mark everything down $2 to $3. That's not going to happen. I mean, I think
it's not, because
we're stuck with these prices.
They are, and it's not just. And trust me, these businesses aren't gouging the consumer. They're not doing it to be greedy. They're doing it because, in many cases, their costs have gone up, and
Sure.
one of the most significant costs that they've incurred is the cost of labor. And it's one of those double-edged swords where, to keep up, consumers need to be making more money. But guess what? Now the consumers are making more money. Those same consumers, they work at the grocery store, they work at the restaurants, they work at the plants that are making all these things that go into it. And when a Chick-fil-A used to be able to pay $8, $9 an hour for an employee, and now they're paying $15 an hour, they can't absorb that. They've got to pass that price along in higher costs for delicious food.
Well, let's talk a little bit about the $1.2 trillion credit card balances that are out there. And the average interest rate seems to continue to inch up. And depending on who you follow, you kind of get different numbers for what they call the average. What are y'all seeing as the average rate these days, considering that there are a few different numbers floating around?
There's lots of different numbers, because there's what an individual card will charge you, and that's going to be really based on your individual credit score. If you've got a really pristine credit score, you've got a 750 or above credit score, you're going to be getting a pretty good rate on that. But if your credit's a little more damaged, if you've missed some payments in the past, your score is down, in the below prime range, you're going to be paying a lot more for that card. It's called risk-based pricing. It's what companies do to make sure that what people are paying is commensurate with their risk. So that's my convoluted way of saying that if you look at consumers who are carrying a balance on their cards, that on average they're paying probably across their cards somewhere between 22 to 25%.
Yeah.
Annual interest rate on their cards. And that's going to depend on, what your risk is. But the difference is that people that are very low risk, they tend not to carry balances. Most people who are super prime, that like 780 and above credit score, they tend to pay off their cards in full every month, which means they're not carrying an interest charge. They not only don't care what their interest rate is, they're not paying interest. They're paying it off. It's the people that are carrying a balance from month to month that are just paying the minimum or paying something less than the whole amount. Those are the consumers that are really feeling the bite of these higher interest rates on their cards.
So let me ask you a question. And with all the research that y'all do at TransUnion, do you have an idea of the percent of people who own credit cards that are holding higher balances, that are getting charged this 22 to 25%? Do you have any sense of what percentage that is?
So the percent of consumers?
Yes.
So it's a hard question, just because by a consumer count, there's roughly 260 million consumers have a credit card balance in the country. That's a lot, right?
Right.
And depending on what period you're looking at, it's going to be easily half of those consumers carry a balance from month to month, and so they are incurring that. And it may likely be higher, but some consumers pay off all of their balances on one card and carry a balance on another, and so it's going to depend. But so it may not be that they're paying interest on their full balance, but maybe they are a portion of that. So you can safely say it's at least half.
Let's talk a little bit about credit going forward. Why are we seeing such stubborn inflation with automobiles?
So a lot of the problem with automobiles is what happened in recent years. So if you remember back in 2021, 2022, we heard all about the supply chain shocks, and we couldn't get semiconductors to build the cars, and then we couldn't get the cars off the boats in California, and all that mess that really caused a lot of problems with consumers that wanted to buy new vehicles. So what happened is there was a lot of demand for new vehicles, and the dealerships, which often look at leases to move metal in normal times, they didn't feel the need to lease. They were basically having consumers lining up to buy the cars, and so the leasing activity went way, way down in that period. Well, what happens down the road? 2 years later, the normal supply of used vehicles, a big flow of that comes from those leases that consumers are turning in. Well, if 2-3 years ago they weren't leasing, then you're not getting the consumers trading in their leases to get new vehicles, and so there's not a lot of used vehicles out there to buy. So all of that means that the prices for used vehicles is being driven up by the fact that there's just not as many of them out there. Consumers often want used vehicles. They're more affordable. You're not paying the full rack rate for a brand new car, and you don't need a brand new car in many cases. The cars are very reliable. But what's happening is that consumers have to pay a lot more for a used vehicle, and until we see some of those effects of what happened a couple of years ago with the supply chain shocks work their way through the system, they're going to continue to be elevated, which really puts a strain on anybody who's looking for an affordable car. There's just not as many of them out there anymore.
So obviously, financing is really taking a toll as well. I mean, you're looking at 9 to 11% on interest rates. That's a pretty big jump.
For sure, and the interest rates on used vehicles has always been higher. So if you feel like the double whammy of used vehicle prices are higher and interest rates are higher, that's kind of a dual effect that's really causing those monthly payments for used vehicles to go way up. And to be sure, consumers who in many cases have to get a reliable vehicle and have to have to be out there purchasing something are struggling with those higher payments, and we have seen delinquencies rise for vehicle loans as a consequence in many cases of that higher payment that consumers have to incur.
So what is the opinion of TransUnion when it comes to the Fed and lowering rates? I've been under the opinion that they won't and they can't lower interest rates when we have no positive confirmation or trend that inflation is going anywhere. What's y'all's take on that?
Well, I'm going to be watching very closely the announcement on Thursday of the personal consumption expenditure price index. It's kind of obscure, right? But everyone talks about the consumer price index, the CPI being the inflation index. The PCE index is the one that the Fed really watches most closely. That's their preferred measure for saying, are we making progress to get down to 2%? And so when that comes out Thursday, that's going to be a real indication of whether we're seeing that progress toward getting down to, if not all the way to 2%, if we're making that progress. And if we see that positive momentum and we start seeing a little bit of weakness in the jobs market, which we are starting to see, layoffs are ticking up. There's a lot fewer jobs out there that are unfilled. And I think those combined weaknesses in the economy as well as that progress against inflation, there's a very real possibility that we might see the first Fed rate cuts in September of this year. Don't bank on it. Don't promise anyone Charlie said this is going to happen, but I think there's a very good possibility. It's most likely not going to happen at the next Fed meeting in July, but September is very much on the table.
So let me ask you a question. The Fed wants to get inflation down to that 2% level. I've kind of been in the opinion that maybe they're shooting too low, that the actual level needs to be up, and where it is today. In other words, inflation may be over, everything may be baked in. What's your take on that?
Yeah, there's you're not alone in really feeling that 2% may not be the mark that we need to hit. And if you look at the PCE index, it's actually much lower than the CPI index. It's below 3%. I think it was like 2.6 last time we saw it. And so, again, I think it doesn't have to hit that mark. It's not like a finish line you're going to get across. Really, what the Fed just wants to make sure is that we're seeing sustained progress, that we're not going to see an unexpected uptick like we saw in February, March, before they feel comfortable that we really have this under control. But, again, if we see between now and September some misleading signs or some signs that hey, maybe it's ticking back up in certain areas, whether it be commodities, whether it be wages, whatever the case may be, rents. If it looks like there's still some possibility that wildfire may have a spark that could reignite, they're probably going to keep them higher for longer because, trust me, it's going to be a lot more painful for them to lower and then have to re-raise rates
Yes.
than just keep them higher for longer.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Charlie Weiss, the Senior Vice President and Head of Global Research for TransUnion, is here to share some of their research with us. Great information. We can't not talk about mortgage rates and what's happening in the mortgage markets. My take on it is that mortgage rates are hovering into the average range that they should be at, really. The 1971 average rate is, since 1971, 7.41%. Is it an assumption that rates are going to go back down to 3 and 4%? Kind of a mistake, because if that were the case, something really horrific would have to be going on with the economy. Are we settling into probably what the rate's going to be going forward?
I think that it is higher than it needs to be right now. I don't think that there's any thought that where mortgage rates are right now is the right level for the longer term. Things have just changed dramatically from where they were, even in like the late 90s. I remember my first mortgage was 7%, and that was in 1998.
Yes.
It felt okay, but you know what? What I paid for my house back then is, it has tripled in that time. So it's really a case of if rates stay where they are and real estate prices stay where they are, there's a whole generation of consumers, certainly the Gen Z and even the younger millennials that are in that prime home buying stage, are essentially going to be sitting on the sidelines for the foreseeable future. There's many markets where they just will not have the income to enable them to get into that home unless they can somehow scrape together 40, 50% down payment. The payments are just simply going to be too high, and lenders will not lend them that 40% loan to income ratio. So what that means is I think that there's room for rates to come back down. I don't think we're going to see a 3% mortgage rate absent a financial crisis in anywhere near the near future, and it doesn't need to be that low. But I do think that a 5 to 5.5% range certainly could be very sustainable, but that's going to be a big improvement over the 6.5 plus that we've seen over the last couple of years. And to be sure, if mortgage rates came down to 5.5%, there are millions of consumers, over 3 million consumers, who have originated a mortgage since 2022 with rates above 6.5%. These are consumers who are going to be thrilled to refinance their mortgage and take hundreds of dollars of monthly payments out of their cost of owning their home, and that's real savings that they can redeploy against lots of other things, paying other bills, even maybe going out to dinner once in a while.
Let's talk a little bit about because I'm just real curious as to what you guys are thinking about the uptick in identity theft and database break-ins. They've been aggressively on the rise. What is TransUnion seeing as the effect of this uptick in compromised consumer files?
So there's lots of impacts. There's impacts on the consumers because it comes down to trust. Consumers are becoming more distrustful of who they interact with, and that's causing them to really kind of shy away from a lot of the advances that we've seen in terms of ease of doing business. So online applications, not just for credit, but for everything. The amount of online commerce consumers are undertaking. Sending money to friends and relatives, all these things, these innovations that have made life in some ways easier. Consumers are getting really spooked by some of this, and I am concerned that a lot of this is causing distrust among consumers. That wow, I just got a note from a friend of mine, asking me if I can pay him back for that loan. Is that really is that real, or is that a scam artist who's trying to come after me? But it's also causing a lot of the response by a lot of lenders, online commerce companies, etc., is to create additional security so that they're not compromising consumers and they're not being themselves defrauded by consumers who are not consumers, but actually synthetic fraudsters who are creating these fake identities or stolen identities to do business. And so they're creating two-factor authentication and all these types of things that are meant to protect them. But it's causing more friction for consumers. You can't get into a banking site without having them have to send you a unique passcode or go through additional, security questions or whatever the case may be. That's friction. People don't enjoy that. That's causing, it's taking time out of people. It's causing additional hassles. And so I think, again, these are all the right moves that are being caused by this, but both lenders and consumers or, companies are all looking for solutions to say, how can we take all of this fraud that's going on, how can we make that someone else's problem to deal with so we can just focus on, if you're a consumer, having a good interaction with a business, and a business making sure that you're giving a great customer experience. Like, that's what we want to get back to. And that's one of the things that companies like TransUnion are working really hard to do, is can we take some of that burden of making sure that consumer is who they say they are, that that they can interact with confidence, that lenders and businesses can interact with confidence. That's what we're trying to do, is create some of that to combat a lot of that fraud that you rightly mentioned.
So let me ask you a quick question. I'm sorry we didn't get to the Consumer Pulse report. I really wanted to talk about that. Is that on the TransUnion website?
Absolutely. If you look at TransUnion.com, there's information on the Consumer Pulse survey, what it talks about, consumers, what they're concerned about, what they're optimistic about. Lots of great information on that, and would encourage anyone to take a look.
Charlie, just great information. So good to talk to you today, and keep up the good work. You guys are doing a great job over there.
Thank you so much, and I look forward to our next discussion.
Absolutely. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Listen, Charlie is right on the numbers when he talks about what's going on with inflation. If you didn't understand that, or it went too quick, or go back and listen to it. We put this on a podcast format. I think he's right on the numbers with inflation, where it is. The first person that I've heard talk of it in these terms, and it'll give you a really good idea of kind of what to expect. Probably not what you want to hear, but it's better to get a good idea of really what's going on versus what the media is telling you that's going on, which has not been accurate. Really, what politicians have been telling you as well, not real accurate. No big shocker, I'm sure. But TransUnion.com, you can get more information about the Consumer Pulse Report. This is Bob Brooks. You got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.